Is the 50-year mortgage the answer to your homeownership dreams? Did you hear the news? Talk of a 50-year mortgage is everywhere. Does the thought of spreading your payments out over half a century sound like you could finally afford to buy a home? Like the ultimate financial lifeline in a tough market? Well, before you're too quick to jump on this method of financing, let us introduce you to an option that already exists and one that gives you an edge. Did you know that at NEXA Mortgage, we already offer 40-year mortgages? The danger of perpetual debt. We understand the need for lower monthly payments, but here's the reality you need to face about these extra long loans. Some experts see the 50-year mortgage as a backdoor way to convert homeowners to renters. You heard that right. Not renters into homeowners, but homeowners into renters. The dream of owning outright fades. With such slow amortization, nearly all will never own their home outright. You could spend your entire life paying monthly to the lender, effectively becoming a perpetual renter of your own home. It passes debt to your children. This creates a never-ending cycle. Instead of passing down an asset, you risk passing on a liability, forcing your children to inherit the debt just to keep the home. I don't think the consumer wins this one. 30 versus 50-year mortgage, the math? Let's look at the numbers. Using a $390,000 loan amount, here's the difference in your monthly payment. A 30-year loan payment at 6.5% interest would be $2,465. A 40-year loan payment at 7% interest would be $2,466. That's a savings of about $59 per month. The interest rate would be higher on a 40 or 50-year loan compared to a 30-year. Because of that higher interest rate, the monthly payment on the 40 or 50-year loan is barely any less. If you really can't afford a 30-year, can you truly afford a 40 or 50-year? This marginal savings might drive some people to buy, but in the long term, this isn't helping most home buyers, especially the young first-time buyers it's intended for. This is why you shouldn't be so quick to jump onto this method of financing. My recommendation, choose strategy over term. While we offer 40-year mortgages, I do not recommend them. What we recommend is the opposite of extending your term. Instead, let's look at an adjustable rate mortgage, ARM. If an ARM offers a lower initial interest rate, the monthly payment is less, hopefully significantly less. The strategy: you take the lower introductory rate, make those lower payments, and refinance in 5 to 7 years, like everyone else usually does, even with a 30-year mortgage, once interest rates hopefully drop. Even if rates stay high and you keep the ARM, you still save money during the introductory period, and the increase after isn't a shock, like the adjustable rate mortgages of the pre-2008 housing market crash. At NEXA Mortgage, we give you the expert analysis and strategic options, not just another debt cycle. Stop settling for a lifetime of debt. Call us today, 828-888-LOAN, 828-888-LOAN. That's 828-888-5626. But wait, there's more. If you are the type of person that really wants to save on overall interest payments and pay off your home loan quicker, NEXA Mortgage offers its own Equity Accelerator. This program is for the person who believes that a penny saved is a penny earned. If you want innovation since President Roosevelt, this is the program you might want to consider. From the creators of the all-in-one loan, this is a monthly adjustable loan from the start. I have one of these myself.
As you're about to learn, the all-in-one is one of the most innovative loan products ever developed. And because it sounds new, for some people, it may even sound a little too good to be true. But it's not new, nor is it too good to be true. Similar programs have been in use for years around the world, in countries like Australia, New Zealand, and throughout Western Europe. Even lenders here in America provide business accounts with many of the same characteristics known as universal accounts and ZBAs. But on the residential side, it seems lenders have been a little bit slower to adopt change.
What consumers should understand is that the 30-year fixed and the 15-year fixed have been around since the 30s. And they have to ask themselves, what hasn't been improved upon since the 30s? Why isn't there a better mortgage option out there?
It might surprise you to learn that most of the mortgages sold today were developed during the Great Depression era. It's a little hard to imagine that something so critically important as a mortgage is virtually the same as it was prior to the Second World War. And while they may be suitable for many borrowers still, the point is, they're not necessarily suitable for all. I think you would agree, it's about time our industry innovates.
There is a better option. The all-in-one loan is a better option for consumers that are simply looking to eliminate a large portion of interest cost.
If you're like most Americans, you've probably financed your home over 30 years. That's a long time. If you refinanced after 7 years or moved, you're starting from scratch and paying mostly interest first. What if there was a way to pay down your loan faster? What if there was a way to save tens of thousands of dollars in interest charges? You could use that savings to secure your financial future. Now there is the all-in-one loan. Unlike a traditional mortgage that charges you interest up front, the all-in-one is designed to pay principal first. By doing so, it reduces your balance faster and saves you thousands of dollars in interest charges. What would your financial picture look like if you had an extra $20,000, $200,000, or $2 million? The all-in-one provides access to your home's equity dollars without the need to refinance. As you know, that's not the case with a traditional mortgage. This is a mortgage that provides you with liquidity. I'm Ruth, your NEXA liquidity mortgage specialist. Let's hear a little bit more about the all-in-one.
So what is it that makes this loan so different? For starters, unlike a traditional mortgage that charges you interest up front, the all-in-one loan is designed to apply payments to your loan principal first. By doing so, it reduces your balance faster and saves you thousands of dollars in valuable interest. What would your financial picture look like if you had an extra $20,000, $50,000, or even $100,000? The all-in-one also provides access to your home's equity dollars without requiring you to refinance. As you know, that's not the case with traditional mortgages. But what truly makes the all-in-one extraordinary is that it combines home financing and personal banking into one. In other words, it's like a home loan that works like a bank account. It comes with ATM cards, bill pay, checks, and all the convenient features you're accustomed to. The all-in-one loan just makes practical sense. It allows you to use your income to lower your loan's principal faster, and you don't have to change the way you spend. By switching to the all-in-one, borrowers have been able to save tens of thousands of dollars in interest and decades off their mortgage. It's flexible, it's easy to use, and it will change the way you think about both mortgages and your money. To learn more, contact a CMG Financial Mortgage professional today. The all-in-one from CMG Financial, the smarter way to borrow.
Hey, my name is Ellen O'Neill, and I live in beautiful Charleston, South Carolina. I have lived in Charleston for about 10 and a half years, and I absolutely love it here. Our city of Charleston is one of the most charming cities in America, in my opinion. When I travel into Charleston and walk the streets, I feel like I've literally been transported back in time. I also love living so close to the beach, so it's kind of fun to live in a vacation destination. We first learned about the all-in-one loan from a mortgage lender who we have worked with closely for years. I'm a real estate broker, so this is a lender who has served not only myself, but several of my clients. There are a few reasons why we chose to refinance our existing loan into the all-in-one product. First and foremost, we were going to become mortgage-free literally in less than half the time than if we stayed in our current loan, which we were already 4 years into. We were going to have a tremendous savings in the interest department. Perhaps even most compelling, there is a built-in sense of security with this loan because of the equity. You have a line of credit built into this loan that provides tremendous peace of mind. I'm very excited about the savings that our family will experience in this loan. We are going to save a lot of money on interest. Most significant savings is that we will pay off our mortgage so much faster, and it'll open up our financial picture tremendously, giving us the opportunity to even retire sooner than we expected. We are on track to pay off our mortgage in about 9.5 years. That is just mind-blowing because we came from a 30-year conventional loan and we were close to 4 years in, and even making an extra payment every year, we just had tapped barely into the principal amount on the loan. It was really discouraging. In terms of our interest savings, when we compare the two options, we will be saving over $78,000 by using the all-in-one. We also have equity now that's available to us anytime we want it. And this is going to afford us to pursue a dream that we've had, which is to pick up a real estate investment property that we can use as a short-term rental. So we can use it to generate more income and also provide a free vacation spot for our family. The all-in-one loan is combining your banking with your mortgage, and it works exactly like the traditional banking means that we've always used. We've had checking accounts and saving accounts with debit cards and paper checks, and all of that is available to us now as well. We haven't changed our lifestyle at all. We haven't had to cut back in any area, and we haven't had to change how we physically go about making purchases. I cannot stress enough how much peace of mind I have felt since we transitioned into the all-in-one product. I am a real estate broker. My husband is also self-employed. He is a general contractor that does home remodeling. We both experience certain times of year where sometimes our industries will be slowing down. Having the equity available to us, we know there is no chance that we will ever default on our mortgage. If we have a lean month, we don't have to feel the repercussion of that. We are not going to be in a position where we're ever going to need to say, which bill do we pay this month and which bill do we not pay? We have all the security we need, and that provides such peace of mind that I can sleep well at night knowing we're covered. It's huge. Open your mind to more than just interest rates. This product is about so much more than just what's the rate. And so for most people that have only had a conventional loan, an FHA loan, even a jumbo loan, we're so programmed to think about interest rate. It's only a tiny fraction of the picture. So look at the big picture, have as many conversations as you need with your lender, and have them use the loan simulator to show you a side-by-side comparison. You'll know right away if it's the right fit. For us, it was not only a good fit because the finances made perfect sense and saved us a ton of money on interest and got us out of debt faster. The peace of mind we have knowing that we're in this product that has the built-in security on the backside, it's just such a relief. I'm so grateful that my lender called me into his office and said, we need to talk.
Let's do a demonstration. First, go to forfloans.com and click on the all-in-one. It takes a moment to load, so I've already gotten one up. We're going to compare a new loan for a primary residence here in Florida. It's not in Texas. Let's say you want to buy a home for $1 million and the loan balance is going to be $800,000. That gives you approximately $5,300 per month when it comes to a 7% interest rate over 30 years. Now, we want to look at what your monthly deposits are. So let's say monthly, you get $4,000, whether that be Social Security or a pension or something like that. And when you sell your home 6 months from now, you're going to have an additional $500,000. Now, you also have some other repeating deposits, so we add those there. So let's say you get a pension for $2,000, or some other monthly income, an annuity. And then let's say you do some consulting work or have commission sales and you get $20,000 quarterly. Those are all of our deposits, and that averages over the year monthly deposits of $12,666 and a one-time of $500,000. So we're going to go to next, and let's say that you're spending, we're going to use an itemized detail. You can also do a percent, but let's say out of that $4,000 and $2,000, you only like to spend that. You don't like to count the big commission check until after you've gotten it. So your regular monthly expenses are only $6,000 a month. That means that you are having less than half of your expenses compared to your annualized monthly deposits. So we're going to calculate the results.
So if you're looking to pay down your mortgage faster and save on overall interest costs, contact Ruth at NEXA Mortgage.